So today in this lecture, I'm just going to explain about all the adjustment entries. And at the end of this topic that you will be able to understand about what are the prepaid expenses, which is also known as current assets, and what is the depreciation, which is also known as non-cash expenditure of the company, unearned revenue, which is known as current liability and deferred revenue, accrued expenses, and also this is considered as a current liability, accrued interest income. So first of all, what are the adjustment entries and total all the adjustments that we prepare at the end of the period, and all the adjustments are totally based upon some of the principles. And three generally accepted accounting principles are timeline principle, which is totally based upon the time, maybe monthly, quarterly, semi-annually, or annually. And second principle is matching principle. So matching principle says the expenses of this year should be recorded this year, because in this year that we have earned money, and to earn money that we have made some expenses in the company, in the organization. Revenue recognition principle says whatever the revenue that you have recognized, you have earned, should be recorded this year, irrespective of the cash received or not. Now, matching principle says expenses are to be matched in the same accounting period as the revenue they helped to earn. And second principle says the revenue is recognized or reported in the same period or the time period when it is earned, regardless when the cash is received or not. There are two bases of accounting. The first one is accrual basis of accounting, and second is the cash basis of accounting. Accrual basis of accounting says that all the revenues and expenses are recognized when earned or incurred, regardless of when cash is received or paid. But on the other side, cash basis. Cash basis says the revenues and expenses are recognized when cash is received or cash is paid. But normally we totally concentrate on the accrual basis of accounting, not cash basis of accounting. Some small organizations follow the cash basis of accounting, but for preparing the profit and loss account and the balance sheet, it means the financial statement for the reporting purpose, they convert into accrual basis of accounting at the end of the period. So basically, we need to understand that we as accountant that always will use accrual basis of accounting, not cash basis of accounting. Some of the adjustments that we made at the end of the period. So these are some of the adjustments. The first one is prepaid insurance. Mean insurance which is paid in advance. So it means which insurance that we have paid in advance for the next year. So that particular amount will not be considered as the expenses of this year. So that will be the current assets for that particular period. Supplies, which is also prepaid expenses, and current assets. Prepaid rent. Rent for 1 year is totally paid today, maybe for next 8 months in the next year. So that particular amount will be considered as a net assets or current assets. Depreciation, we will discuss. Unearned revenue, which is known as deferred revenue, interest expenses, salary expenses, and services revenue, accrued service revenue. So all these points that we will discuss one by one in this topic. Starting with the prepaid expenses. So what is the meaning of this? All the cost paid for in advance of receiving their benefits. It means they are recorded as an assets. As these assets are used, their costs become expenses. So common prepaid expenses are insurance, rent payment made in advance, maybe for 1 year, supplies purchased for use in the business. I'm just going to explain this with one example. Prepaid insurance by Archer Limited is there and is paid like $2,400 for 2 years of insurance protection that is going to be begin on December 1st, 2022. Now we need to record At the time of purchase of insurance, what we did, prepaid insurance account debit to cash, $2,400. Because cash is paid today on 1st of December 2022, $2,400. And we know that the accounting period will end on 31st of December 2022 after 1 month. It means, technically speaking, we have used only 1 month insurance for this year, but we have paid a lot of money for the next around 23 months. Now, in this case, what we need to do, the first transaction that you can see here, the cash is paid for the 2 year insurance in advance, $2,400. This is the first entry that we have. Now, what kind of adjustment that we need to make on 31st of December? By December 31st, insurance coverage is used and causing a portion of the assets prepaid insurance to become an expenses. That portion which is already paid will become the expenses for this year at the time of making some adjustment. This expenses, how it is calculated, look at this. So $2,400 that you can see here and divide by 24 is $100 for 1 month. We know that 1st of December 2022 to 31st of December 2022, it should be to 1 month, right? Our adjustment entry to record this expense and reduce the assets, that will be insurance expenses account debit to prepaid insurance. So insurance expenses is $100. This is nominal, debit all expenses and losses, and this is expenses natures. And when the expenses increase, that we debit. We know that. On the other side, we can say to prepaid insurance. This is the current assets, right? And the credit the giver. So $100 that we credit here. So 1 month insurance expenses that will be used. This is the one adjustment that we have done. So after adjustment, how we can interpret this one? After adjustment, $2,300 that will appear on the asset side and $100 that will be considered as expenses that will come under the income and expenditure account. If adjustment is not made, for example, on 31st of December 2022, what will happen? It will be showing that the $100 expenses that will be understated. So $100 expenses is not posted in the income and expenditure account on the expenses side. It means the profit will be overstated. It will show there is a more profit. Why? Because that we have understated $100 as expenses. So when the profit is more, it will show equity is more. Means equity is more overstated. Supplies purchase. Next point. Normally, supplies are purchased in the business and used when required during the year. At the end of the year, we come to know how much supplies are used. For example, opening stock of our supplies are here, plus purchase during the year and minus closing supplies at the end of the period. So in this way, we will come to know that total supply used during the year. So when total supply used during the year, that will become the supplies expenses, not only supplies. Only supplies if we talk about, so those only supplies are the current assets. So I would like to explain what is supplies. Supplies may be, take an example of any institute, maybe some extra mouse or batteries, maybe something like cleaning liquids, uh, maybe a water bottle, or maybe you can say a hand wash, maybe duster or a marker, or some wires. So these kind of stuffs, maybe a bundle of papers, pen, and other items. All these are considered as supplies. But all the organizations, institutes, colleges, universities, or maybe other big organizations, they don't buy on daily basis. They buy in bulk, right? And when they buy in bulk, those supplies will be considered as current assets of the company. When from that supplies, we use some of the items for this year, maybe for 12 months from the 1st of January till 31st of December for 12 months, that particular expenses, that particular supply expenses will be considered and will put on the debit side of the income and expenditure account as expenses. Look at this example. RJ Private Limited purchases supplies of $5,000 during the year and found 3,500 supplies at the end of the period. It means $5,000 they were purchased. At the end, they found and calculated that 3,500 supplies at the closing stock. It means where that 1,500 has gone. So 1,500 that will be considered as supplies expenses. But at the time when the supplies were bought, the entry that would be supplies account debit to cash. So supplies here are the current assets. So supplies are real, cash is real. So as per the golden rule of accounting, we know that debit what comes in, supplies has come. So current asset it has increased. On the other side, the cash has gone. The real credit what goes out, current asset it is decreased. And at the end of the period, we found that 5,000 minus 3,500, $1,500 is considered as the supply expenses during the year. So supplies expenses account debit to supplies. So here the assets means supplies are the assets. Assets has gone down by 1,500 and expenses has gone up by 1,500. Expenses that will put on the debit side of the income and expenditure account as expenses for this year, and the supplies that will be reduced by $1,500 in the balance sheet. On the asset side of the balance sheet, there will be a current asset. Supplies $5,000 minus this is $1,500, and that remaining will be $3,500 as it is shown here. Next is the depreciation. This is also one of the very important adjustment that we made at the end of the period. And depreciation is a non-cash expenditure of the company. When calculating depreciation for the partial period, when an item is acquired during the month, and we use a policy which is known as the nearest whole month policy. Under the nearest whole month policy, it says the depreciation of a month means 1 month, is calculated if the assets was in use for more than half of the month. If it is more than 15 years, 15 days, 16 days, 17 days, the assets is used, we will consider the assets is used for 1 month. So this is known as nearest whole month policy. So look at this. So what depreciation is? Depreciation is the reduction in the value of the assets over the period of time. There are some important points that we need to understand about the depreciation. There are some methods, but the most important method is the straight line method of depreciation. This method is used to calculate the depreciation. We need to have three things. The first one, the cost price of the assets, then the salvage value, and the estimated useful life of the assets. Cost price that we know. Take an example that we bought a truck, $17,000 is the cost price. And 2,000 is what? So 2,000 is a scrap value. After estimated useful life of the assets, means after 10 years, there is a scrap value. When you dispose of or sell that truck after 10 years, you will get $2,000. That is known as salvage value or residual value or scrap value, one and the same thing. So how to calculate depreciation for 1 year? Because we know that we calculate all the expenses every year, right? Or so depreciation for 1 year is to be calculated by using the straight line method. $17,000 is the cost here, minus 2,000 divided by 10, that is estimated useful life of the assets. That will be $1,500 for 1 year. We have assumed that the assets that was bought in the month of May 10th of May. It means the full month of May will be calculated, right? Because that it is used for more than 15 days. 10th of May, from the 10th of May till 30th of May is around 20 days. More than half month, for the more than half month, we use that truck. So from May to December, 8 months total that we have, and for 8 months, $1,500 into 8 divided by 12. So $1,000 will be considered as a depreciation for this year and will appear on the debit side of the income and expenditure account. Now look at this. May 10th to 31st of December 2022, 8-month depreciation is 1,000 and truck is used for more than half month in the month of May and will be considered as a 1 month for the purpose of calculating depreciation. So 1,000 depreciation expenses truck account debit to accumulated depreciation truck $1,000. So first one is the nominal and second one is the real. So nominal, that we understand all the expenses and losses, all the income and gains that comes under nominal account. And we know the rule, if this is expenses, debit all expenses and losses. Okay, but how we can say that accumulated depreciation is a real? So accumulated depreciation means whatever the depreciation every year that we are calculating, right? Go back and see $1,500, that is every year. It means $1,500 for 10 years that we will calculate. Accumulated mean $1,500 for the 1 year, then $1,500 for the second year, third, fourth, fifth, till 10th. So slowly, accumulated depreciation account will be created. So it means reverse of the assets account. Means the fixed asset that we have, truck. Truck is the fixed assets that we put that assets on the fixed asset side. Under the asset side, there's the fixed assets column, and under this that we write $17,000 as a truck value minus accumulated depreciation $1,000 for the first year, and in the second year 1,000 plus next year depreciation 1,500. Next year we want to calculate 1,000, 1,500, then 1,500. That will be 4,000 will be deducted, and the remaining balance will be the net value of the assets. And we will do this exercise later in the depreciation examples that I will explain later as well. Now next is unearned revenue. So from the name it is clear, revenue means that the income that we are generating by selling of some goods or services. Unearned, actually we have received, but that is not our earning. Let's have a look. Cash received in advance of providing goods and services, but services not yet provided. This unearned revenue is also known as deferred revenue and will be considered as the liability of the company. When cash is accepted, an obligation to provide the goods and services is also accepted. It does not mean that cash is accepted and we will not provide goods. Take an example. When the cash is received by providing cleaning services for next 4 months, right? And let's say today is December. For the month of December, for the month of January, February, and March. For January, February, March for the next year, and for this year is only December. And $400 that I have received in advance. For this year, I will consider the revenue for this year only 100, not 400. And what about the 300? So 300, that will be considered as a liability of the company, because that services that we have not provided. Services that we have not provided. So that is known as unearned revenue. Okay, earning will happen only when you receive money and provided the services. It does not happen when you received money but have not provided services. Right? So that is known as unearned revenue and will be considered as a liability of the company. Okay, now at the time when the product and services are provided, now time comes, maybe next month or next to next month, when you have provided cleaning services or you have provided some goods, then what happened? The amount of the unearned revenue that will become the earned revenue. So this kind of adjustment should be made at the end of the period. So unearned revenue account debit to revenue. So that will be the journal entry. Now look at this. Adjustment for the unearned revenue example. On 1st of December 2022, $3,000 received in advance for providing cleaning services in startup building for 3 months. It means $1,000 per month, for example. December month services is provided successfully. It means for this year, December month services is provided. But what has done? We have received $3,000. Look at this. The cash account debit to unearned revenue $3,000. But in this case, that 31st of December, this adjustment is required because we are going to close the books of accounting for reporting purposes, and the financial statement, the profit and loss account and balances should be accurate. Unearned revenue account debit to service revenue means the revenue of this year should be recorded this year, right? So this is the general entry that we have made. So this is what I have done. So cash account debit to unearned revenue here. So unearned revenue becomes the liability. So by $3,000, and at the end of the period, the unearned revenue, which was a credit here, now it is the debit, and the service revenue is credited. So ultimate effect will be the unearned revenue, that will be the liability of $2,000 in the balance sheet. So what will be the effect of the adjustment on the financial statement for this? Revenue will increase by 1,000 on the expenses and income. Income and expenditure on the debit side and credit sides are there. On the credit side, $1,000 will increase and shown on the income side of the income and expenditure account. On the other side, liability has decreased from the $3,000 to $2,000. Now, next point is accrued expenses. Mean expenses due but not paid. Expenses are due for this year but have not paid. You should pay this one, but you did not pay due to some reasons. I will explain with some examples. The things or the money which is due and not paid, that will become the liability for your company. The costs incurred in the period that are both unpaid and unrecorded prior to the adjustment. Unpaid means that have not been paid. Normally, if you say, so generally it relates to the expenses incurred for services provided or the product received for which the company has not been billed, not yet to be billed. Accrued interest expenses are there. Accrued salary expenses are there. So I'm taking these two examples to make you understand. The first one is accrued interest expenses. Accrued mean due but not paid. Due but not paid, that's known as accrued expenses. Now, if you talk about interest, like $6,000, for example, our company has received money at the rate of 5% interest per annum. So the amount that will be for the month of December, that will be $25 only. Mean 6,000, 5% is equal to 300. 300 divided by 12 is equal to 25 per month. And if not payable, that we have $6,000 that we received as a loan from the bank, let's say, and we need to pay money for this year. This year means till 31st of December, we need to make entry for this adjustment. So now, interest expenses account debit to interest payable. It means interest was due but not paid. So, but interest money that we have received for this year and expenses related to that money should be recorded this year. So $2,500, not 2,500, it's a $25 that should be recorded here. So interest expenses account debit Debit all expenses and losses, the nominal account, and interest payable is the liability of the company. So that we have 25 here. Let's say next year on January 10 that we pay cash, that $25. Then the cash will go from your company and interest payable account debit to cash. So in this case, that liability will decrease by debiting this liability. We debit the liability, that decrease. We credit the liability, that increase. Now, similar kind of expenses is the accrued salary expenses. Assume that salary is being paid on 10th of every month for the previous month worked. Salary, for example, $2,500 due for the month of December 2022, but paid on the month of January 10 next year, 2023. Now, in this case, that your employee has worked for the month of December, but you did not pay money. Normally, it happens with the organizations. If you are working somewhere, in the month of December, you worked in that company, maybe in the Costco or Walmart or Tim Horton, but you did not get money in that month. And you know that 31st of December is the closing time of this whole calendar year or financial period. You received maybe after 2-3 days, maybe 10th of January, maybe 5th of January next year. But at the time of calculation, recording purposes, accounting says that the money that was due but you did not pay till 31st of December. That particular amount is known as accrued expenses, accrued salary, accrued interest. Now look at this. So salary expenses, we know the expenses of this year should be recorded this year. This is the matching principle says. Expenses account debit $2,500 to salary payable $2,500. So due but not paid means that is a liability. But expenses of this year should be recorded this year. So this is expenses, nominal, all expenses and losses are debit. Next year, when salary is paid by cash, so salary payable account debit to cash. So in this case, that liability we are going to debit, it means liability is going to decrease and cash is real. The cash has also gone from the business. Next we have accrued services revenue. What is the meaning of accrued services revenue? Just like accrued expenses, we have accrued revenue. And revenue earned in a period that not yet received and unrecorded. It means the revenue which we have earned has not received. Let's take an example. I have provided, I means my company has provided a grass cutting services or landscaping, garden, cleaning, and $500 is due, but I have not received that money. But I have provided the services, but money I have not received till 31st of December. But the customer has paid a check of $500 with one date, that is 5th of January 2023. I have received that check, but I will encash that check only on 5th of January or after, not before. What does it mean? It means till 31st of December, I have not received money, but no problem. Services has been provided. So services revenue should be recorded for this year in which the services have earned. Look at this. Accrued revenue are a part of revenue and must be reported on the income statement. It means services is provided, but money is not yet received. Look at this example. Cleaning services of $1,000 is provided in the month of December and money is received in the month of January. So account receivable, account debit to service revenue. We know that the services revenue are the income and we put on the credit because we know the rule. This is nominal first of all, credit all income and gain. And account receivable, that will become the assets because money that still we have not received but will receive later on. That will become the current assets for our company. At the time when the money was received next year, then what happened? That cash account debit to account receivable means that our the current assets has gone down by crediting this one. Next, in nutshell, we can say the expenses and revenue. We always and most of the time adjustments are to be made for the expenses as well as revenues. If in expenses we say there are prepaid expenses or there are some expenses which are due but not paid. On the income side, there are some unearned revenues are there. Means money that we have received in advance but have not provided any services. That will become the liability for the company. And accrued assets means revenue is due but not received. That will become the assets. Now, what we have learned today? So we have learned the prepaid expenses, depreciation, which is non-cash expenses, unearned revenue, accrued expenses, and accrued interest incomes, and how to calculate all these transactions, these adjustments, entries, once everything is completed on 31st of December to show the accurate picture to the outsiders of the company.